Good afternoon and welcome everybody to the Wednesday Lunchtime Drive Through on Wednesday, June the 1st, 2022. I'm your host, Damon King. I'm a certified financial planner professional and wealth management advisor with ChappelWood Financial Services in usually lovely Edmond, Oklahoma. But today I'm looking out the window and it's a really rainy, gray, wet day. But that's okay. We'll take the rain because here in another month or so, we'll all be complaining about how hot it is and wish that we could get some rain. So I'm never going to complain about that. Today is a very special topic. What is indexed universal life insurance? And we actually have a special guest, and I'm going to introduce him here in just a minute. As you all know, the whole point of the Wednesday drive-through, and really any of our educational programs, which we offer through ChappelWood University, which is the educational branch of ChappelWood Financial. We always want to bring things to you that maybe you don't hear any other places, or maybe you've barely heard about it, but you want a little bit more insight and information about things. For example, many of you have been asking about I-bonds. You've been hearing about I-bonds on radio and television lately. And so we've been talking, just got off the phone with a client a moment ago, explaining what is an I-bond. And so one thing that a lot of people have been asking is, right now, with the market the way it is, I've got cash that I'm ready to put to work, but I don't want to put it in the market yet. I want to wait until things kind of bottom out and then I'll invest it. But in the meantime, or is there some other place that I can put my money than the market and still earn a decent return? One of the strategies that I've been hearing more and more about over the last few years is something called indexed universal life insurance, or IUL. I'm going to admit to you, and I tell you, when I don't know all the answers, I don't know all the answers. And if I don't know about something, but I want you to know more about it, I bring in the big guns. I bring in the heavy hitters, the people who can talk about it. And so I'm very excited to welcome today our special guest, David Falcone. He is a regional vice president with Midland National Life Insurance Company, and he's on the life insurance side. So many of you know Midland through the annuities side. Many of our clients on the call today have an annuity through Midland National Life, but there's also life insurance. And David is on the life insurance side. So David, welcome to the Wednesday Lunchtime Drive-Through.
Thank you. I appreciate the opportunity to be here with you and your guest today.
Well, hey, first things first, what does LUTCF mean? That's a big acronym.
Life Underwriters Training Council Fellowship.
Okay. All right. So suffice to say, you know what you're talking about when it comes to life insurance. So thank you so much. And we're very honored and blessed to be able to call upon our partners like you who know this stuff and can give us the simple explanation of what's going on here. So as I just said a moment ago, David, I'm getting more questions from clients and just people who listen to our radio show. They've got cash or they expect to have some cash, whether it's in the form of mineral royalty payments that they're getting or an inheritance, or they're just saving cash and they want to park it someplace that is not the market. Now, we know the market over long periods of time usually performs pretty well, but right now things are a little dicey in the market. So it's not surprising that people are looking for a little bit of safety. Safety can come in the form of bonds. It can come in the form of insurance contracts. And so one of the ones that I wanted to talk to you today about was indexed universal life. So I'm going to start with the most basic question. What is indexed universal life insurance?
Sure. So indexed universal life, or you'll hear it referred to as IUL, is a permanent product that provides both protection and growth. It combines basically a traditional death benefit type protection that's provided by life insurance, plus the potential cash value growth, which is linked to the performance of a stock market index, and it does have a minimum interest rate guarantee built in also. So it's a product that offers both protection and growth, as I just mentioned, in a permanent format.
Yeah. Okay. Which, so basically it's a cash value life insurance policy. And, what I talk about in my classes, there's different kinds of life insurance, term life insurance. Most people understand that. You buy life insurance, you pay a certain premium every month, and you have that policy for a given number of years. And then once that's over, then the policy expires. But what you're saying here with IUL, it's more permanent, kind of like whole life insurance is permanent insurance, right? You've got universal life, you've got variable universal life, all these different things. And real quick, ladies and gentlemen, I also want to remind you that if you have a question today that you want to ask David, please use the Q&A button down below or the chat button. You can always ask any question. Please interrupt. This is your time, and I want to make sure your questions get answered. So we know now what IUL is, or kind of the basics. So why would somebody choose an IUL policy as a strategy for their money? I mean, term life is pretty simple, right? I mean, it's easy to understand. Why would I want an IUL policy versus some other kind of life insurance, or even some other kind of strategy for my money?
So as I mentioned earlier about the permanent, aspect of it, it's really for someone who is focusing on a few different, aspects, such as one could be legacy. So, first and foremost, again, it is a life policy, and that death benefit is something that clients can find value in terms of, hey, later when I want to pass this on to the next generation, my beneficiaries, that death benefit leverage allows them to do that in a way that's greater, because that death benefit that's passing to the next generation is larger than the premiums paid. That death benefit also can be accelerated. So with living benefits, that allows that death benefit now to be accessed while the client is alive, should they have various events such as a critical illness, a chronic illness, or a terminal illness. And basically what that means is they can access a portion of the death benefit and use that money to pay for care or expenses, qualified expenses, while they're alive. So the legacy, the acceleration, and then you have the growth aspect. So again, the IUL will allow you the opportunity to earn, an interest based upon the upward movement of a stock market index. So you're not directly invested in the index, but it is linked to the movement of the index. And so this gives you the opportunity to participate in upward growth with downside protection without having to directly invest in alternative higher risk type products.
So it's earning interest based on linked to a market index like the S&P 500, right?
That is one of the indexes that is in the makeup. Yes.
Okay. So I know on the annuity side, if you have an indexed annuity, you earn interest when you participate in market growth. You don't participate when the market goes down, negative. And in those years that the market goes negative, your interest earned for that year on the annuity is zero. Is that the same on the life insurance? So for example, that year, if the index goes negative, I don't earn anything, but I'm not losing anything either. Is that correct?
That is correct. So you will never be credited less than zero, which means if you, every year when they calculate the index, if there is a negative index credit, then the amount that's credited is zero. Any previously credited amounts will stay in the policy to continue earning. So you have that downside protection because the crediting rate can never be less than zero.
Okay. And you mentioned, because one of the things that I was really interested in was the death benefit you mentioned. So you're saying that the death benefit can actually grow beyond what you initially put into the policy. So you're funding this policy. How does that death benefit grow? I mean, is it earning the indexed link, or is it a fixed amount that it grows every year and then it stops at a certain point? Could you kind of speak to that a little bit?
Sure. So initially there will be an established death benefit. That's what you're underwritten for. That starting death benefit is available from day one, obviously as a legacy piece. So if something happens, that is the death benefit that would pass on to the beneficiaries. And again, that is the death benefit that is available for acceleration. Now, over time, as the account value uh, potentially grows through the index crediting and it builds up, the death benefit also will increase as the account value increases, because that corridor is being maintained between the account value and the death benefit. And so over time, let's say 10 years from now, that death benefit can be higher. And if so, that is again the amount that would transfer as a legacy piece. And that's also the amount that now becomes available for acceleration. So even though 10 years ago the death benefit was lower, and 10 years from now it's higher, they have the advantage of being able to accelerate from the higher death benefit now for living benefits.
And you mentioned acceleration, and so just to clarify what acceleration of the death benefit means, it means if you don't do anything with it, if you don't touch it, then when you pass away, then your heirs get whatever's there. But you have access to some of that money, or maybe all of it. Do you have access to 100% of the death benefit, or is it only a certain portion?
So it depends on the type of condition being accelerated in, but the majority of the death benefit is available. You would always still have a residual or leftover type death benefit after the accelerations have been maxed out. So there's still always going to be some death benefit available for beneficiaries. But yes, you would have access to the death benefit for, again, three different accelerations: critical, chronic, and terminal. And so the critical is things such as a severe stroke or severe heart attack, or maybe kidney failure or severe cancer. That would be examples of a critical acceleration. Chronic acceleration, or things such as a severe injury or illness, where you would need assistance with 2 of the 6 activities of daily living, or let's say you developed a mental or cognitive type impairment, such as Alzheimer's or dementia. Those are examples of what a chronic illness acceleration would look like. And then a terminal illness, which is defined as a life expectancy of less than 24 months. So these accelerations allow for that death benefit access, and that money that is accelerated becomes available for you to use for various levels of care or various level of services.
Okay, and that's kind of interesting, because I was just talking with a client earlier this week, and the conversation was about long-term care. And how do we fund our long-term care? Do we buy long-term care insurance? Do we fund it with our assets? And one of the things that they were looking at was, okay, the husband has a life insurance policy with a death benefit of like $450,000. Okay, so it only gets paid out to his wife if he dies. There is no current benefit that he could tap into that to pay for nursing home if he had to go into a nursing home. So one of the options we're looking at is possibly replacing that policy with another life insurance policy that does provide for that. And paying for that life insurance policy is a heck of a lot cheaper than if they had to go out and buy long-term care insurance. Is that a possibility? If someone's got an existing policy, could they replace it with an IUL policy, like with a 1035 exchange or something like that, to be able to have that benefit?
Sure, a 1035 exchange is available. And so if, in the analysis, it would make sense to look at a newer policy with additional riders or features that weren't present on the existing policy, then yes, that would be an option to go ahead and proceed with an exchange to get the newer policy for those additional features and benefits that they're looking for.
Okay, so now to the next question. How do you actually fund an IUL policy? I mean, are you paying monthly premiums? Do you buy it in one lump sum? Can you explain how that works, or are there different options, different ways of doing this?
Sure. So the Index Universal Life is flexible in terms of how you would like to look at funding it. So you can do a single premium. You can do a shorter pay type design, such as a 5 payment or a 10 payment or a 20 payment type design, or you can do what's called an all payment, where you pay all years, out to even age 120, let's say, or age 100. So you do have the flexibility to design the premium schedule that fits into what you're comfortable with, and that could be monthly, it could be annual, it could be quarterly, semi-annual. So you do have a variety of options that you can look at.
Okay. And how are people, what kind of money can you fund this with? Does it have to be before tax? Can it be before tax money like an IRA? Or does it need to be cash, or after tax money that you're using to fund this?
Yeah, so it's typically funded in a non-qualified fashion. So, yep. So qualified accounts would not be available to fund the life policy. It's typically done with, after tax type dollars.
So can you kind of give us, you don't have to get too into the weeds. Can you give us an example? Okay, so say I've got $400,000, okay, cash that somehow I've just got. And I might want to invest some of it, or maybe I want to keep it safe. And if I want to keep it safe, I don't really want to put it into an annuity, but maybe I'm looking at this. So how would I go about getting that 400 in there? You mentioned you can do it as a single premium, so you could fund it with a full $400,000, or you could put in $100,000 every year for 4 years or something like that. Is that correct?
That is correct. So you could spread those payments out, again, as a lifetime pay, or pay to age 65, or 10 payments, 5 payments, a single payment. So again, you've got a lot of flexibility there. And then again, it really, the great thing is you can look, at a variety of options and see which one kind of potentially produces the best result, and which makes the best, scenario for you to consider in terms of how you fund it.
Okay. Now, one way that I've heard a lot of people like to use an index universal life policy, so they'll fund it, okay, over a period of years, let's say. Then later on, when they get into retirement, rather than actually tapping into the cash value, because as with any policy like this, the growth is tax deferred until you pull it out, right?
That is correct.
Okay, so if I tap the actual cash value, I'm going to pay taxes on that. But instead of doing that, I actually take a loan against the policy, and that loan is not considered taxable income. So that's what I've been hearing, people basically funding these policies and then at some point tapping them via policy loans and using it as tax-free retirement income, essentially. Is that really what people are doing? Is that a valid way to use these?
So the loan provisions are available inside of a life policy. And, first I'll kind of speak to it in terms of the amount of premiums paid. So in a life policy, the cumulative premiums paid, or your cost basis, let's say, is available for you to withdraw at any point first. So unlike the annuity, where you would have to withdraw gain first, right, your premiums or your cost basis is available to withdraw first.
Yeah, that's a good point. Thank you for just what he's saying is, with an annuity, if you want to pull money, partial gains out, it's taxed on a last in, first out basis, meaning the last money added, your gains are considered to come out first, so they get taxed. But with life insurance, it's first in, first out. So the first money you put in is deemed to be the first money you pull out. And in this case, premium that's tax-free. So thank you for sharing that. So.
Yeah, no problem. And then once you get to the point where you are now going to look at taking gain out of the policy, meaning you've already exceeded the amount of premiums paid, so your cost basis has been exceeded, then you have a couple of options on how you would like to access the gain. The first is you could just withdraw it simply, and that money would come out, and you would get a corresponding let's say 1099 for that, okay? Or you can look at the loan provisions, and it's where it's the loan provisions that people are most interested in terms of accessing the gain, because now, as you just mentioned, you can use the loan provision to access the gain. You would get use of the money, and then depending on what type of loan provision you elected, so meaning there are a couple of different options. One is a guaranteed net zero cost loan option, so you could access it using that, and that money is moved to a separate account, and it doesn't earn anything, but it doesn't get charged an interest rate either. So you can restore the loan at some point. You can keep it out as long as you like. And again, because it's being made via the loan provision, you would not get you would not be receiving a corresponding 1099 for that. Or you can utilize what's called a preferred loan option, which is where that money is sent out to you again at loan, but that money is put into a separate account and it's charged an interest rate. And that interest rate is what you pay to have use of the money via the loan option. But then that money that you're using out, via the loan is not removed from the index credits. So if the index credits are lower, the difference is your loan cost. If the index credits are higher, then the difference is your positive in terms of what I was credited and what my loan cost is. So let me give you an example. Let's say your loan cost is 3%, okay? And the index that year was negative. So you're going to remember, you're going to get a 0% credit that year because the index was negative. So there is no index credit due. And that money is being charged 3% loan cost. So there's your true loan cost now, in terms of the loan itself is 3%, versus let's say the index credits were 5% that year and your loan cost was 3%. So now you have a higher index credit than your loan cost. So the difference would be your index credits minus any internal cost minus the loan cost, and the difference would be your net amount that's added to your account value.
Okay. So yeah, I mean, in some cases, the loan can make sense because it's tax-free, first of all. And that income, if you're using it, it's not going to tax more of your Social Security. It's not going to increase your Medicare premiums because those are based on taxable income. But it's also maybe a lower cost way than having to go to a bank and get a loan, especially right now with interest rates going up, and maybe I'm sure loan rates on IUL policies will go up too. But that's kind of interesting. I've heard of people doing that a lot. And I was just curious. Now, I would assume, though, that if you take a loan against the policy and then you pass away, any unpaid balance on that loan is going to reduce the cost of the death benefit that gets paid out to your heirs, correct? It's going to be.
Yes. So there's let's say, the loan account and then the death benefit. And the death benefit in relation to the loan would satisfy the outstanding loan balance, and then the net amount would be the remainder that's passed to the beneficiaries.
Okay, great. And just, ladies and gentlemen, just as a reminder, if you've got any questions that you would like to ask, please type them into the Q&A or the chat box down below, and I'll be happy to share them with David here. All right, so there is no financial strategy on earth that is foolproof, always works for everybody. There are always pros and cons to every strategy that we might employ. So I'm just going to ask you, what are some of the potential cons or downsides to using an IUL policy versus using that money for something else?
So first of all, remember, you are utilizing a life insurance policy, okay, for some of the features and benefits that a life policy can offer you. So first and foremost, if you're just not in a position where the life death benefit is of value, you certainly wouldn't want to fund that product or life product because you have the cost for that insurance. But if the legacy part of it is, hey, I'd like to maybe reposition so that something does happen to me, I at least know that I've got this leverage that will, bypass probate. It will go quickly, to my beneficiaries by contract. And so I'm satisfied that I can use my premium, efficiently to provide that leverage. The second piece is, because of that, you have you would want to have an interest in the accelerations. So meaning you're alive and something happens and it becomes important to you that you can go to that benefit and utilize that for care while you're alive. So there's really a couple of things right there, right off the bat, you want to, answer for yourself is, does having these two things make sense? And then the other piece is the growth piece. So, by utilizing a variety of the index options that are available, you are positioning that premium to grow. And so if the index or indexes that you select are providing positive index returns those years, then you are participating in the upside potential. If the index credits are negative, then at least you do have that 0% floor there. So you do have the opportunity to participate in the growth. You do have the opportunity to access that account value later for a variety of purposes. That could be in a supplemental stream each and every year. It could be as a single withdrawal for emergency purposes, or it could be as a single withdrawal for a specific purpose in and of itself. So you do have options later on how you access that money. So again, I think that the first and foremost are the legacy and the acceleration. But then if you are going to do it past that, you'd want to make sure that it's funded properly, meaning the ratio between what you're paying and what you really need in terms of the death benefit are appropriate. And so if the focus is more on the growth, you'd want to properly have that design so that it meets the strategy that you're looking for.
Yeah. Yeah. And again, this is just like with an indexed annuity. This is not a strategy you are going to utilize if your investment goals are max aggression, max growth. That is market-like. That's not what this is designed to be. But if you are looking for safety, you don't want to lose any of your money. You want access to the money for different things, whether it's for spending money or whether it is for long-term care or medical care or to leave a great legacy, then IUL, Index Universal Life, can be a great way to do that. And so, well, hey, David, is there anything else that you wanted to share today regarding IUL? I know that Midland does provide these kinds of strategies. That's why you know so much about them. I mean, let's say somebody here has a desire to learn more about it. They give us a call. I mean, kind of what's that process if they want more information, or how do they begin that process, I guess?
Sure. So they would just reach out to you regarding their specific situation. Then you can help them kind of identify what goals and objectives they have. So example, let's say it was they were putting into a CD or a money market, and they were looking maybe for a little bit more upside potential without really taking on a lot of the risk on the account value side. And so they're looking at a single premium. You can show them a design where that single premium, again, provides that leverage, provides that acceleration, provides that potential growth, but also Midland, National does have an early cash value product. So it's a product that does allow them higher early liquidity, in the first couple of years. And so that could really be a design worth considering. But if they would reach out to you regarding their specific situation, we can get, illustrations designed and run and sent over so that you can share that with them, have a conversation, and see if that could be an appropriate solution for them.
Okay. Well, thanks so much, David. Appreciate your time today and shedding some light on this. So like I said, it's not something that you hear a lot about, but I've had a few people ask about it. So I thought, hey, that's what the drive-through is all about, education and learning new things. So thanks so much for sharing that with us today.
Absolutely. I appreciate the opportunity. Thank you.
All right, and everybody else, thanks so much for joining us today. It is just right around 1 o'clock, so that's it for our time today. If you are not yet a member of the ChappelWood family and you'd like to sit down with us to talk about your specific situation, get out your phone and use the camera on your phone, and you can actually scan that little code, that little box that's right there, and that'll take you to a website where you can put your information in, and you'll schedule a 30-minute phone call with Shelly here in our office. And she'd be happy to answer your questions, and we'll figure out a way how we can best serve you. And if you have a question about indexed universal life or any other strategy that's designed for protection of assets, obviously we can talk to you about that as well. So thanks so much for joining us today. Enjoy the rest of your week. Stay safe, and we'll see you next time on the Wednesday Lunchtime Drive Through. Bye-bye.